Scott Bauer joins us, CEO of Prosper Trading Academy, to do a little trading on the mothership. What do you think, Scott?
I've never been in a world of mothership probably since I saw Close Encounters of the Third Kind or whatever that was 35, 40 years ago. This one for space, Oliver, you know me. I've never really been into the meme stocks, the Wall Street bets, the Reddits. But I look at space here, and you got to look at it two different ways. Technically, it's a short. Okay, so much resistance, 50-day moving average. Technically, it's a short. Do I want to short a $7 stock? I really don't. So when I look at it from the options side, I got to do something where I know I'm protected, and I want to leave myself, obviously, room for profitability here. So Alex made a great point. Alex said this is a very binary stock. Stock could go to, 50, 100, infinity on some good news or some technology, and it could also fade away into the abyss, like he said. So what I'm doing from the option side is I'm playing both sides of this. I'm going out to October. I'm buying the October $6 put. I'm also buying the October $8 call. I can do that for about $2. So the stock doesn't do anything until then. That's my risk, is $2. But what this allows me is if the stock does fade away to the abyss, let's say it goes to zero, I make money to the downside, or actually $4 is my break even to the downside. If something comes out, this thing gets caught up with the Reddits of the world again, or, the stock pops, my break even on the upside is $10, and then I have an infinite amount of return to the upside. So that's the only way that I would play this, is having an opportunity to make money on both sides. It doesn't come without a cost. It costs me $2 to do that. I know my risk. That's the way I would play this.
I like that. And it's not often this type of trade. We don't get a ton of these because it's a tricky one. It basically means that there's, you get paid if there's a big explosive move in either direction. But for this type of stock, it seems kind of perfect. If there is going to be some big wave of speculative euphoria again, this company's going to get caught up with it. It's been beaten down so much. It's basically the definition of high beta. If markets get dragged hard again and make new lows, then you get paid off on the put. So you're looking for a big swing. I like it.
Absolutely, but it doesn't come without a cost, right? You look at the $2 and say, okay, $2 is the equivalent of $200. That's my maximum risk. But when you look at the $2 as compared to the stock price of $7, you're saying, wow, I've got to pay 29, almost 30% of what the stock costs right now to hold this position. So it's not an inexpensive position, but it is a way to play just a big move in either direction.
That's a good and important reminder that you are buying a lot of premium, right? So you're not, without selling any puts or calls against either side of this. You're just owning volatility in a stock that's pretty volatile. So it's even more kind of expensive than if you were to try and do this trade on a dull, quiet company. But then the odds that it would pay off if you do this on a staple stock or something are pretty low. So there's that trade-off, basically. All right.
Absolutely. And it's very key for everybody to understand this is completely a speculative position. This is one, you were just in Vegas and you know it better than anybody. The odds are probably not with me on this position here because the premium is so high. You obviously want to go into a trade or into a poker hand or whatever it is when the odds are in your favor. But again, this is the only way that I would play something like this.
Okay. All right. I like it. So you take a volatile stock and make it work with your own kind of version of embracing some volatility. I like it. Appreciate it, Scott Bauer. Thanks. CEO of Prosper Trading Academy with the strangle on Virgin Galactic.